Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Christine Johnson, Head of Fixed Income for Old Mutual Global Investors, to give her 3 bond picks. Hi Christine.
Hi there.
So what's the first bond you'd like to highlight today?
So, starting in at the deep end, it's a company called FMG, Fortescue Metals Group. They're the second cheapest iron ore producer in the world. Now, I know commodities have not had a good time in the last few years, but that's why it's now time to start looking at them. What we really like about Fortescue is their ability to control their costs. What they've managed to do is to bring down their cost of bringing every tonne of iron ore actually to the market. They've brought that down by more than 50%. That means that they're starting to generate cash. So if you're a bond investor, what you're really interested in is, can this company actually start to generate cash at the bottom of the market? So they've brought down their per tonne cost to 25. The iron ore cost now is actually 60. So they're producing plenty of cash. And what are they doing with that? Well, they do have quite a lot of expensive bonds outstanding. They have a bond, for example, with a 9 7/8 coupon. That's a lot of money for them to keep paying that coupon. So what they're doing is they're starting to tender for those bonds and they're starting to buy them back. So even now, we've had some performance in these and we've done really well by being kind of a little bit brave and a little bit ahead in terms of getting invested. But even now we're seeing value, because if they tender for them, great, you get immediate upside. But if they don't, you're still getting paid that 9 7/8 coupon.
I mean, you've caveated it there with being bold and being brave, but most people would say, you know, commodities, terrifying place to be. I suppose it's about picking the quality bonds, because there's a lot of junk out there.
There's a lot of junk out there, but what it meant was, when we had the sort of general panic last year, was you had lots of good things getting thrown out with lots of bad things. So it's the case now exactly of just going through and say, okay, so who probably deserves to have been thrown out, and who actually, like FMG, are able to flex their business model and survive through this, and therefore can I take advantage of indiscriminate selling.
And your second bond pick is another quite punchy one as well, isn't it?
Absolutely. It's Brazil, which sort of last year, it was beyond redemption. It was just seen as an appalling country with loads of problems with whether it was inflation, whether it's their dependency on oil, whether it was the corruption problems. But we looked at Brazil and we remembered what happened to Iceland. Iceland is now a great country. It has 6.5% growth. It's a fantastic country. But if you remember 7, 8 years ago, Iceland was, again, it was untouchable. It was considered to be, you know, beyond
We had to bail them out, didn't we, with the savings accounts?
So it's looking now at the most hated and actually thinking, well, perhaps if all the bad things don't come true, there's another reality where this country can actually start to claw its way back. There's definitely a sea change in Brazil where they want to get rid of corruption and they want to move on from the past. So again, for Brazil, we're looking at bonds which are relatively short-dated. They have a 14.5% yield. So even if they don't move up in price, I'm happy just taking the yield. But our anticipation is the central bank will actually start cutting rates and we should get price appreciation as well as the yield.
And for those people who are perhaps not as brave to take the first 2 picks, what's your third?
Oh, I can understand they might not be for everyone. So right at the other end of the scale, I'm going to say the US 2-year Treasury bond. It doesn't sound very exciting, but when I tell you it's got a yield of about 85 basis points, and that gives you a break even, that means how much you could withstand in terms of yield rises before you lost money. It's got about a 75 basis point break even. If you just want a buy and hold where you get a positive return and you know you're going to get your money back, US 2-year looks pretty good.
And those 3 picks do help to paint the picture of a very diverse bond market, which I think a lot of people don't realise sometimes. They think equities, of course, they can be heterogeneous, but bonds, they're all the same. Definitely not the case.
Definitely not the case, and it's really a world where you want to think about active managers. I understand completely people sometimes want to buy passives, but if you want to look across the whole piece and say, where can I get value, where can I express views, then you have to start thinking about active managers and probably strategic managers who can make these choices.
Christine, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.